The healthcare sector is set to grow in the coming years as aging population, demand for life-saving medicines, and R&D spending increase. According to a report published by Deloitte, healthcare spending is likely to increase at a CAGR of 3.9% between 2020 and 2024. Let's check out 10 medical sector stocks to buy now. Number 10. Merck & Company Incorporated. Merck is one of the world's largest pharmaceutical companies and leading vaccine producers. Hardy says his bullish outlook got a boost when the Food and Drug Administration recently granted emergency use authorization to Merck's COVID-19 oral drug molnupiravir. In addition, Hardy says the Acceleron acquisition could be a significant growth driver for Merck by contributing to the depth of its portfolio and expanding its presence in the cardiovascular disease treatment market. Finally, Hardy says the spin-off of Organon will generate $1.5 billion in operating efficiency by 2024. Number 9. SpringWorks Therapeutics Incorporated. SpringWorks Therapeutics is a clinical-stage biopharmaceutical company focused on rare diseases and cancer. J.P. Morgan analyst Anupam Rama says top-line Phase 3 desmoid fibromatosis, or DeFi, trial data for leading asset nirogacestat should be released by early 2022, a potentially transformative catalyst for the stock. Number 8. United Health Group Incorporated. United Health is the largest U.S. managed healthcare firm. Bank of America analyst Kevin Fishbeck says every United Health segment is reporting impressive growth numbers, and the company's overall guidance for 2022 appears to be conservative. Fishbeck says the market doesn't fully appreciate United Health's earnings power, and Optum Health will continue to be the company's engine for long-term growth. Beyond its Optum Care clinics, United Health plans to double its value-based home and community care business in 2022. The company's data analytics business, Optum Insight, is also expanding its margins. Bank of America has a buy rating and a $522 price target for UNH stock, which closed at $494.13 on December 22nd. Number 7. CVS Health Corp. If you live in the United States, you're probably familiar with CVS. It's one of the largest pharmacy chains in the world. It has close to 10,000 locations across the U.S. and employs more than 36,000 pharmacists, physician's assistants, and nurse practitioners. In total, its workforce numbers more than 300,000 people. The company's second quarter financial results showed just how strong CVS is. During the quarter, analysts forecast that CVS would generate earnings per share of $2.06. The company blew that figure away, actually reporting EPS of $2.42, coming in more than 17% ahead of what analysts expected. Revenue. During the quarter, the company generated $72.62 billion, beating analyst expectations of $7.3 billion. Moreover, the figure showed a staggering growth rate of more than 11% year-over-year. Increased earnings guidance. Due to the blowout quarter, the company increased its earnings guidance for the full year. Now, instead of expecting $7.56 to $7.68 per share in full-year EPS, the company said it expects to generate between $7.70 and $7.80 per share. Number 6. Johnson & Johnson. Prior to the COVID-19 pandemic, when you thought about Johnson & Johnson, one of the first things that came to mind was likely baby powder and child-friendly shampoos. While its consumer staples arm is important to its bottom line, the company is far more than your average consumer staples company. Johnson & Johnson is a full-scale biotechnology company that develops vaccines and pharmaceuticals for the world's most pressing conditions. In fact, the company has a portfolio of therapeutics on the market today approved by the U.S. Food and Drug Administration to address 20 indications, including cancer, epilepsy, and Alzheimer's disease. For example, its multiple myeloma treatment, Darzalex, generated $692 million in sales in 2020, up 42.4% year over year. Number 5. Teladoc Health. Teladoc Health is a COVID-19 play as well, but they don't create vaccines or treatments. Instead, this is a healthcare technology company. The company's claim to fame is an on-demand service that connects patients to doctors, therapists, and other medical specialists online rather than in person. Many patients, especially elderly patients and those with pre-existing conditions, don't like the idea of seeing their doctors on computer screens. They wanted face-to-face interaction and didn't see any value in avoiding the commute to see a doctor over the computer. That has changed for many of these high-risk patients as a result of the COVID-19 pandemic. With patients being afraid to leave their homes but still needing access to medical services, Teladoc appointments quickly became the norm. Number 4. Pfizer. When investors think of Big Pharma, Pfizer is one of the first names that come to mind. Founded in 1849, it is one of the oldest and largest pharmaceutical companies in the U.S. While Pfizer has long been popular among investors, it became a household name among consumers as well, as part of the Pfizer-BioNTech collaboration that received the first FDA approval to market a COVID-19 vaccine. Of course, the vaccine is generating significant revenue for the company, which is exciting, but it's not the most compelling aspect of the investment thesis here. No matter where you look in the world's most high-value pharmaceutical indications, whether it be oncology, immunology, or cardiology, you seem to find a drug developed and marketed by Pfizer. That kind of leadership is nothing to shake a stick at. Number 3. AbbVie. With a market cap of well over $213 billion, AbbVie is another of the largest pharmaceutical companies in the world. The company's claim to fame is a drug known as Humira, which has been approved to treat 16 different conditions, many of which are incredibly high-value indications, including rheumatoid arthritis, Crohn's disease, juvenile Crohn's disease, and ulcerative colitis. The drug is such a big hit that it generated more than $19 billion in revenue in 2020, and it's expected to see growth through 2021 and 2022. However, it's also a double-edged sword, and likely the reason the stock is trading at a low valuation compared to its peers in Big Pharma. Humira enjoys market exclusivity in the United States until 2023, after which generic versions of the drug can be produced, cutting into the company's profitability. Although revenues from the drug are expected to decline during that period, the company is preparing to offset the declines, projecting revenue growth in 2024 and beyond. Number 2. Vertex Pharmaceuticals. With a market cap of around $52 billion, Vertex Pharmaceuticals is a massive company, but it still has plenty of room for growth. Vertex Pharmaceuticals is a biotechnology company founded in 1989. While it doesn't have the longevity of the likes of Johnson & Johnson or Pfizer, the company has quickly proven it has what it takes to compete with the big dogs in the healthcare space. The company's claim to fame is its work in cystic fibrosis and its leading drug known as Trikafta. While Vertex does market other drugs as part of its cystic fibrosis franchise, Trikafta is the clear winner, generating more than $3.8 billion in revenue for the company last year, and that number is expected to grow exponentially ahead. Nonetheless, the stock is trading at a significant discount to last year's prices, largely due to a mishap in a clinical trial that led to investor fears that the company won't be able to provide blockbuster treatments outside of its cystic fibrosis franchise in the future. As is often the case in the stock market, the mishap seems to have created an opportunity. When the discontinuation of the clinical trial was announced, the stock fell like a brick. Investors were hurt by the declines in the stock when VX814 was scrapped, but that reaction was significantly overblown. Number 1. Intuitive Surgical. Intuitive Surgical is a medical equipment company. As the name suggests, it's focused on surgical systems, in particular, surgery robots. The company's robotic system is known as the Da Vinci. The Da Vinci system is used in various general surgeries, as well as in urology, gynecology, and several other specialties. Of course, a robot that helps perform surgeries comes with a hefty price tag, generating about $2 million in revenue for the company with each sale, and sales are booming. In 2020, the company sold 936 systems, even during a time when the COVID-19 pandemic led to a massive reduction in the number of surgeries being performed. With vaccines becoming widely available and hospitals and surgical centers reopening their doors for elective surgeries, there will likely be a flood of consumers that have been waiting for an opportunity to go under the knife, meaning that the surgery industry as a whole is likely to see explosive growth ahead. This bodes well for Intuitive Surgical, setting the stage for tremendous growth ahead and making the stock yet another for the watch list. Do let us know in the comments which one of them you liked the most. Please subscribe to The Stock Advisor. Thanks for watching.